Yes, I mean, we can see counter-trend rallies from here. It's very normal in bear markets or downtrends to see rallies to the upside. They're called bull traps for a reason. It's very common, but the challenge we have is that we have a lot of overhead resistance, and we haven't seen those signs that are typically consistent with a big flush in markets. We're looking for things to be so bad that they're good, and those signs aren't at extremes yet. They're elevated, but they're not at extremes.
Rich, but things have felt so bad. Do we necessarily need that capitulation moment, the VIX to 40? Because I'm looking at the VIX right now. It's 23. Does history have to repeat itself every single time?
Scott, I'm not sure history has to repeat itself, but I think, look, there's the thing that I think people have to understand about volatility is that volatility always signals a change in leadership. What happens is that the old leadership in the stock market was geared to a certain economic environment, in which case for tech innovation disruption, it was secularly falling disinflation, secularly falling interest rates. That's changing, and that's why you get volatility. A new leadership emerges that's better suited to the new economic environment. And so volatility is painful, but I think as a real investor, what you have to start doing is trying to analyze what that new environment is going to be like, and what leadership is appropriate for that new economic environment.
But I just don't understand why technology wouldn't still be it. I mean, technology represents what the future is going to be. It's disinflationary, so I don't understand why couldn't technology be that?
Well, Scott, it could be if we hadn't had sort of this bubble-type valuations associated with it. Look, after the tech bubble, all the stories came true in the next 10 to 15 years about how the internet would change the economy, about how cellular communications would change the economy. It all came through. But if you bought NASDAQ in December of 99, it took you 14 years to break even. So we have to separate out the story from the valuation of the assets. And tech is still one of the most overvalued sectors in the market today.
You agree with that? You're shaking your head, yes.
Yes, definitely. If you look at tech as a valuation relative to the market, it's still trading at an 18% premium. And you could think that it's worth that they're better companies. The thing is, prior to 2019, tech actually traded at a discount. And so there is a precedent for tech to trade at a much smaller premium at least. And we've still seen big inflows into tech innovation and disruption. There's been $1.7 billion of inflows into ARK. So this really isn't capitulative.
Yeah, it's a good point you make. You also make the point that if you think the Fed is aggressive or tight now, that the game is just getting started.
Just you wait, because at 75 basis points on the Fed funds rate, they're targeting to get to neutral, which is 2.35 based on the dot plots, by the end of this year. And they want to go beyond neutral to be able to control inflation. So if we think that inflation might roll over a little bit, it's certainly not going to keep them from delivering on those rate hikes. And guess what? They haven't even started quantitative tightening. They haven't even stopped their bond or started the tapering of bond purchases or the cutting of the balance sheet.
Right, rolling the balance sheet.
And so the challenge we have is that yields probably do see pressure as they exit the market and they become a seller instead of a buyer.
Rich, there are some who suggest the Fed, everything Cameron said is correct, but there are some who suggest that the Fed's going to overshoot as a result. It's going to be too tight, it's going to overshoot, and then it's going to back off.
Well, you know, Scott, every cycle ends with the Fed panicking. And I think that will undoubtedly happen in this cycle, too. But Cameron's point is very important. The real Fed funds rate, which is basically just the Fed funds minus the inflation rate, is historically negative. Prior to every recession in the last 50 years, it's been positive. So we have a long way to go before the Fed is actually trying, literally slowing the economy, let alone fighting inflation. People say that they're becoming more hawkish. I would agree with that. But it's sort of like hunting an elephant with a pea shooter. You're hunting, but what's the success going to be? Your weapon is way too small. That's exactly what's going on right now with the historically negative real Fed funds rate. Yeah, they're tightening. Yeah, they're on their way. But we're like in the top of the first inning.